Okay, so guys, let's get started. We are 10 minutes over the top of our hour. Again, the welcome everyone to our discussion number 291, and another 10 weeks we'll be hitting 300 mark. So thank you for joining in and keeping me motivated to come here and talk every Saturday. We are close to 5.5 years. It's been since I've been doing this, and it's all because you guys want to you keep me on toes, right? You come up and show up here, and then I need to prepare something so that we can talk about it. So thank you for showing up. Like I mentioned earlier, today the main agenda, of course, I will cover the macro level and maybe a couple of stocks. I'll also look at what's happening at a high level on the crypto market, but the meat of today's meeting will be around fixed income investing. I forgot who had requested it. If you are there, just let us know that you had asked for fixed income investing. But this is the topic I think which I had touched upon.
Vivek, I'd ask for it.
Okay, cool. Thank you, Vinay. But this is the topic that I have covered and touched upon in very fragmented way over last 3-4 years. But picked up one particular item around fixed investing and talked about it basically because I read about it in a magazine or in a research report, etc. So I thought, why not do one consolidated fixed in a session on fixed income investing. Look at what are the various avenues of fixed income investing, benefits and risks. Again, the whole idea is around, as a retail investor, how to basically make use of these instruments which are available. And I think me as well and many of you might be just thinking about the fact that stock market over the last 2 years, or almost I would say 2 and 3/4 of a year, has been on fire, right? We had great 2023, almost 26%. We had great 2024, close to maybe 24%. Then so far in 2025, we are almost 10%, right? So might be thinking, oh, come on. Maybe I should, lighten up. I'm not saying that you should, but it's depending on your situation. If you're thinking maybe I should lighten up and move over towards where I have a little more guarantee of income, maybe a little less in terms of interest rates, etc. That's where a lot of these fixed income instruments will come in picture, right? So we're gonna talk about that. So that's the overall agenda. And then at the end of the meeting, we'll break out into different breakout rooms where you'll have a opportunity to go degen and deep dive into option trading, some strategies, or swing trading, futures, etc. Whatever else you want to talk about. All right. That was the main stuff. So let's get started. As always, anything that we discuss here is only for education and maybe a little bit of an entertainment and maybe a little bit of socializing, but it's definitely not an investment, tax, or financial advice. Right. All right. I heard some background noise, so please stay on mute if you don't have a question. So looking at first thing, I know a couple of questions were there. Friday, it was a time well spent for me. I attended this event from Tastylive in San Francisco in the Regency Ballroom. And now I understand, after attending the meeting, now I understood why they did on Friday, because this time their agenda was a little different. This time their agenda was to actually do live trading on account with $500,000. And both Tom and Tony, they had done close to 36 trades in 90 minutes, around 30 securities, well diversified, using ETFs, individual stocks, and futures, options, everything, and built up a portfolio and consuming around 130K of buying power with almost zero delta. So it means no delta risk and close to 450 of theta a decay. And it was like quickly, the whole idea, I think what Tom and Tony wanted to present was, as a retail investor, you don't have to overthink many of your trades if you're just going by the mathematical probabilities and building a diversified portfolio. And now I know why they have to do it on Friday, because earlier their events were generally over the weekend, but then the market is closed on weekends, right? You really cannot do live trading. So it was fun. For me, I mean, I just go out because, I learned a lot from them. That's how I got started. My journey into options is through by watching them, and then I just go and meet them and say thank you for changing my life. So it was a well attended event. I would say close to more than 300 people, and well received. And I was, you know, was able to meet a few of you in person. That's always fun to go and meet in real life. Of course, we meet once in a week on the Zoom, but it's a different vibes when you're meeting people in person. And also, I did not realize it until I came back home that it was actually Teachers' Day. Yesterday was Teachers' Day, and you know what? What better occasion can I ask for this event where I can get to meet and thank my teachers on Teachers' Day, right? So it was I really enjoyed this. I enjoy these meetings, especially going and talking and meeting with other retail investors, which was fun. Uh, anyone else want to pitch in? I know a couple of you were there. You want to pitch in with your idea of what did you learn? How did you find this? For me, it's mostly because I just want to go and meet Tom and Tony and some other investors. H. Johnson is saying, was there anything learned at TST Trade event in SF? See, for me specifically, my idea was not to go and find something new, because they talk at very high level. But I guess if someone is attending for the first time, you'll probably realize that, there is a method in which you can actually trade options and without trying to gamble the market. So unfortunately, most of the traditional financial media has scared people away from options, saying it's gambling. But there are right ways to treat options, which is to hedge your portfolio to generate some cash flow and all that stuff. This is what I've been focused on, and one of my idea is to come and talk about it so that each one of us retail investors can also pick it up and do it the right way. That's what Tom and Tony generally focus on. So if it's for the first time someone attending, I'm sure there is a lot to learn. Pankaj is asking, Sid says you didn't make it. I don't think they record the event. So probably they did not. There will, or maybe go and check on Tastylive if they put it up or not. Aditya, happy Teachers Day, Vivek bhai. Yeah, I'm not a teacher. I'm an investor, but yeah, I do love to talk about it. And thank you, Aditya, for showing up. And hopefully, whatever I talk, it's helping you. That's good to know. Which they offer Zoom meeting or recording for us to learn. They do events at a different locations in US. So Ramesh, maybe you want to check if something near Chicago. I know the firm is from Chicago, but maybe near Michigan or somewhere they're doing events or not. I know they have one coming up near LA. And Aditya, you're gonna attend that. You told me. They recently did in New York. So they do have a look at the calendar of the events. They do these events across the country.
Yes, very quite. The one in LA is in October, I think. Yeah. I can check the date and confirm. Yeah.
Cool. Using options with zero delta. Yes. So their overall portfolio beta weighted delta after doing trades across 30 tickers. And of course, they also did zero TT, which I don't do it. Their overall portfolio beta weighted delta was around 16, right? Using 130K or 140K of buying power, which means almost zero directional risk. Not exactly zero, you still have a 16 SPY, but practically not much of a risk. But of course, if you're using only options, you have to continuously adjust your deltas, right? The market will move, your deltas will change. Okay, so let's talk about on the coming to the traditional markets on the macro side. So we had a labor market report that came out on Friday, and it looks like the August job report, which comes from the government, was weaker than was expected. So only 22,000 non-farm jobs were added, which is well below the expectations of 75,000 jobs. So weaker job market from a non-farm payroll report. Also, the job openings, overall job number of jobs that are open were less than the total people who are looking for jobs, right? Than the total number of people who are unemployed. It's the first time in 2021 that the number of people that are looking for jobs are more than the overall job postings, which is a little scary. And this does not include people who have now given up, or either they have taken early retirement, or they have moved on to do some other stuff in life and say, you know what, I'm not hunting for jobs. But there's a bunch of people, there's a group of ex-employees who have now decided that they're not going to go back to the employment market. So if you add that into the total number of people which are unemployed, the situation is not good when it comes to the labor market, right? Also, the private payrolls. So the ADP comes up with a private payroll report for August. That was also weaker than what was from a previous month. So both the private report as well as the government report was weak. The number of job openings is less. So clearly, we are having very much weaker job market. And also the June numbers was revised, and this always happen. The numbers get revised after a couple of months, and it is for the first time since 2021, since 2020, that we had a negative number. So instead of a job the job gains, we actually had lost the number of jobs. It's the first time in almost 5 years that there was a job loss. So very clearly, the job market is very, very tough. And I think these are the numbers that showed up, but anecdotally, we know that, it's not easy to find jobs, especially, even if new graduates are having really tough time. Companies have been able to use, better technologies to do the work of 4 people by using just 1 person. So job market has been really tough. Clearly, there's been a softening going on, but if you're looking from an investing perspective, it's good for the markets. I hate to say this, but sometimes the bad things for economy is good thing for the stock market. Stock market has got addicted to the easy money, easy drug money coming from Fed. So with the labor market softening, what does that imply for Fed rates? Right? We know during the Jackson Hole meeting, Jerome Powell did talk about it, saying, that they're gonna pay more attention to the labor market. So we know that if there's a labor market is weakening, Fed will step in to support the economy, or basically by injecting liquidity, i.e. reducing the rates. So I think it's 100% given that we're gonna reduce the rates. Now only the question is, are we gonna do 25 basis points or 50 basis points? So prior to the reports coming out, job numbers came out, market was pricing in 25 basis points rate cut, which is very standard. Fed would like to move slowly, but now there is slight chance that maybe we could also have 50 basis point rate cut. So this is the strange relationship between the job market or the economy and the stock market. Is the job market deteriorates, but only to a certain extent. Then the stock market will go higher because we're gonna get liquidity from the Fed. But if it deteriorates too much, which markets start to think, oh, our economy is going to crash, then the stock market will crash. So right now, I think we are at that Goldilocks situation, whereas, yeah, the job market is softening, its cracks are there, but those are not the cracks those are not the big holes, right? So these cracks can be repaired by Fed coming in and injecting some liquidity, reducing the rates, which bode well for the stock market. And hence, I think we are still hitting a new all-time high on SPY. So I was looking at a Fed probability, CME Fed Watch tool. So now if you look at 90, almost 89%, we're going to get a 25 basis point rate cut. And then we also have close to 11% is maybe 50 basis point rate cut. These numbers were like 98% last week before the before the jobs reports came out.
Hey, Vivek,
Yeah, go
can I
ahead.
just interject a little bit here?
Yeah.
Yeah, so Vivek, I don't think it's it's the liquidity or the lack of liquidity or interest rates or even AI that's causing this issue with the job market. I think it's the current policies of the administration that's causing a lot of uncertainty, and therefore businesses are not sure where to invest and how to invest. That's my viewpoint anyway.
I don't disagree. There is some
Because
element.
AI is very transformative and it should be very good actually for the market and the economy because people will invest, there'll be a lot of productivity gains. But you can't have these gains if I don't know if you saw that the tech leaders meeting with the president, right? It was more like a North Korean kind of
Yeah.
show, right? And businesses, and there was this big the South Korean thing got raided, the factory. So all this just creates a lot of uncertainty, and I think people start shying away from investments in the US.
Yeah. So I don't disagree with that. The uncertainty always, will cause businesses to hold back on investments. But let's say if Fed does cut interest rates, it will at least be able to spur some more expenditure and economy. Right?
A little bit, but
Yeah.
I think it will remain this thing.
And I think whenever the new transformative technology comes in, there are the generation that there's one portion of the labor market which will always bear the brunt of new technology, right? Coming from, let's say, from an industrial revolution to the automation to the mechanized production, then came internet. There is always a section which will feel the pain, but over a longer period, it's always good for economy as well as good for labor market. But the transition period is always very difficult. There is one generation that will feel the pain, and then the subsequent generations will find out, wow, that technology is great. Right?
Yeah, and I've been through many transitions, right? It is painful, but here I'm seeing something different somehow, right? I think, I mean, I don't have the ability to do research, but I think this is more like when Putin came to power in Russia, right? I think that's the way the economy is going to go.
Yeah, we'll see. We'll see what happens, but for now, the stock market was like hitting a new all-time high, and someone watching the, hey, you have uncertainty around the whole labor market. The market is hitting all-time high. Yes, over the last, I would say, 10 years, this has become a trend that market is getting little addicted to, lower rates, and you'll see market behaving positively on some of the negative news around economy. It is what it is. Right? I can't change it, but all we can do is understand how and why the market is behaving and see if we can take advantage of it. So also on the bond market side, we had outside moves on the bond market. So the 2-year treasury yield, which is the short term, generally that's what the Fed rates will drive. So Fed only sets the overnight borrowing among the banks, that rate, right? So that doesn't directly impact. Fed is not going to set what's my auto loan would be or what's my mortgage would be, right? Those are set by, those are the rates which are set by the market, right? But 2-year treasury closely tracks what the Fed fund rates would be. Mortgage will generally track what the 10-year note rates would be. Right? Again, that's all determined by the market. So 2-year treasury yield, was at the lowest level. It slid down to 3.5%. Also, 10-year was also moved lower, which is good, right? If a 10-year moves lower, it means generally you see the mortgage will follow what the 10-year note is. So mortgages could move down to 6%, 5%, which will spur more, the activity in the housing market. Housing market has been kind of a dead for almost 2 years, right? And all the subsequent activities, if the housing market starts to pick up, you will see a lot of, it has got a cascading impact on a lot of other industries as well. So that would bode well if housing market starts to pick up. So I think we also saw some of these housing market stocks. I own XHB. Wow, I had a nice jump on Friday. There is another one, ITB. I think that's also home construction ETF. Almost similar behavior. Again, the expectation was, hey, rates coming down, 10-year coming down, it means mortgage will also come down, which will spur more housing activity. But we're not done yet. We only got the labor number. Now we have an inflation number, which will come out, this coming week. And if you recall, Fed has got dual mandate: maximum employment and price stability. So on the maximum employment side, labor market weakening means Feds probably will cut rates, bring down the rates. But if the inflation numbers come higher, that's gonna put Fed back, questions saying, should we even cut rates? Everything is high. Stocks market is all-time high. Inflation is high. Then should we even cut rates? We'll see what comes out. But if inflation numbers stay higher, I won't be surprised to see some weakness in the market if the numbers come more than expected. Right? Or we are in month of September, and September is seasonally it's a very volatile month, and generally it's a month which is on an average it's a negative month. So right, we might have some more volatility coming out just because seasonally it has been like that. I don't know why it is, but I think I have a chart which shows you the monthly average returns across different months. Maybe we'll get to that. But if we get some of the weakness, I'll be looking to add, either some quality businesses on banking, financials, because if you look at the short-term rates come down and long-term rates still stay a little, are still strong, that will bode well for the banks, because banks generally borrow at a lower period, and then when they lend the money, they lend it at a longer period of time, right? 30-year mortgage. So if the so-called as a yield curve, right? If we see more softening on the short-term rates as compared to the long-term, it means if the yield curve steepens, that probably will bode well for financials. And of course, any rate cuts is good for mid and small businesses segments. IWM, I'll be looking maybe to add some more position or do sell a short put on IWM. Housing, we already talked about. Biotech, which is always in need for money, right? These are the moonshots, and if you can find and raise funds cheaper, it's good for biotech and discretionary sectors, etc. But we'll see what happens. We are only a week into September. We still got 3 more weeks to go, right? Looking at a little bit on the equity side, let me read some comments. Jose say we currently priced in 3x.25 or 325 basis point for the rest of the year. Most likely we'll end up with 2x. Yeah, I think probably let's go back to Fed Watch tool. we are looking at, I mean, the market is expecting 3, as you rightly said. What we get or not, we'll get to know once the inflation numbers, etc., that came out. But market is currently pricing in 3 rate cuts. And I think till 2026, we got another 3 rate cuts. So overall, 6 rate cuts for till end of 2026. And these numbers could change. We have one inflation report come out, these probabilities will change. But this is as of like Friday, what the market is pricing, the probability of rate cuts. All right, on the equity market, Mr. Musk is getting $1 trillion package. It looks like $50 billion or whatever the current pay package, which is mired in court case. I think it was close to $50 billion. That's not enough. So now we have $1 trillion package, which basically coming from, it's not that the board of directors has given him $1 trillion in cash. It doesn't have that. Basically, additional $424 million shares grant for the CEO of Tesla, Mr. Musk, who is already the richest person on Earth. And they got a performance award. This is based on the new proxy statement that was filed with SEC. He'll be eligible to receive these shares, and which will be worth $1 trillion if he hit all his milestones. Right. And before you start to worry about why is getting so much money and all that, let's also look at what are the conditions on which he'll be eligible for this reward, right? So there are 12 conditions that the company has to meet, or the Elon has to make sure that Tesla meets those 12 conditions, which some of them are based on the market capitalization, right? The Tesla's market cap has to hit those milestones. And also, it's not just market cap, also the financial or operation milestone, right? 12 market cap milestones, 12 operational milestones. Because sometimes the market cap milestones can be met by just because the market is bullish, just because there is craziness in the market, whether your company has really performed or not. So I was happy to see that there are actually operational milestones related to the business of Tesla. And if Elon hit all these milestones, yeah, it'll be worth $1 trillion. Maybe he'll be the first person to hit $1 trillion mark, right? Which is, I don't even know, $1 trillion. Wow, that's too private. Sam, you have looks like you have a question.
A comment. Last night on Bill Mayer, they said would I don't know who they said, but they said would Elon Musk be a better leader or some politician? And actually, the people there said Elon Musk. But personally, I think Elon Musk is a lousy business person. What do you think?
I don't think he's a lousy business person. He just overcommits, but he delivers. Just that it takes a lot more time for him to deliver. But that his style of working is.
Well, he's not honest, I mean, like dealing with Twitter, then he gets distracted from his businesses with his government work.
Yeah. So I mean,
I think that's a bad illustration, though.
Yeah, so that's the reason why I think the board of directors want him to focus on. And looking at this grant, it clearly tells you if you're a Tesla shareholder, this is where something called a key man risk or woman risk, right? Key person risk. Let me be politically correct, right? So this is a key person risk. God forbids if Elon, anything happens to Elon, right? The valuation of Tesla will crash, right? He's so important for the company that the board is willing to give him $1 trillion so that he can focus on Tesla and Tesla can meet these milestones, right? And this is the pros and the cons of investing in a company in which you have one key personality that can either make or mar the company, right? And that's why it could stay very volatile depending on what comes out of his mouth or what comes out of his, post in Twitter. But you gotta be comfortable with it. So looking at what are the 12 milestones, right? So these are the market value milestones and the operational milestones that Tesla will need to hit if, for Elon to get whatever the 425 million shares, right? $8.5 trillion or $8.5 trillion market cap for Tesla. I forgot to know, around what time frame is it? And many of these operational milestones, 20 million vehicles delivered, 10 million active FSD subscription, 1 million robots. I think this is Optimus, 1 million robot taxis, right? And $400 billion of adjusted EBITDA. What's Tesla valuation right now? Look at Tesla. I guess it's $700 billion or something. What's Tesla's? Oh, it's $1.1 trillion, right? So you're looking at, as a shareholder, I'm looking at 8 times. I'll be okay. I'll be okay for give him $1 trillion because it's also, he's committing to increasing the share, the market cap by 8 times. I mean, I know there was a lot of a discontent around the current pay package, which is now mired in the court controversy. But if you look at the commitments that he had to make when in 2018, when his pay package was finalized, these were some ridiculous milestones that were set for him, right? I don't think any other CEO, and I've talked about it earlier also, like any other CEO would have taken up the challenge which Elon took in 2018, saying no cash payments, give me these many shares if I hit these milestones. I wish every CEO of the companies that I hold in my portfolio take that bet, right? But when he delivered, then you should keep your part of a bargain, which is to give him $50 billion. Not that I'm a big fan that a CEO should be getting $50 billion, but come on, there was a deal made, there was a contract made, and he delivered on his part. And when we got into the contract, the whole financial media laughed at Elon, saying, come on, how ridiculous it is to agree to such egregious milestones, but he delivered, right? So this one also seems to be very egregious, but if he delivers, he'll get paid $1 trillion, right? Don't cry later on. Either to change it now as a shareholder or be okay with if he increases your wealth by 8 times, because he's committing to get the market cap to $8.5 trillion, then let him also enjoy increasing his wealth. Naresh saying, if inflation is not going to come down with all tariffs, RKT is all-time high. Yeah, RKT is all-time high because Rocket Mortgage is become a much bigger player after they bought Coopers. They also bought Redfin. They also bought Cooper's Mortgage for servicing. So RKT is becoming a overall 360-degree player in the mortgage origination, servicing, etc. So it's going to be a formidable player. And the housing market corrects, RKT should go even higher. I don't think it is an all-time high. Where is RKT? Maybe a 52-week high. $20? No, I've seen it at $30 plus. This was the only company which I'd invested like immediately after IPOs. I remember it. And it went up to 30 plus. Because it was a profitable company. Jose says the valuation of Twitter is back up and they've returned to profitability. Now, Twitter, I have one comment. Twitter being a private company, its valuation is what the bankers will decide to be. And if you go and look into the history of, how the deal was sponsored by JP Morgan and some of those banks, and they just couldn't get it off their balance sheet. It's between what Elon and the bankers and some other companies agree to value Twitter on. So I'm very skeptical when folks talk about Twitter valuation, because there is no free market to determine the value of Twitter, right? Let's say if Elon wants to sell a portion of Twitter to a bunch of investors, which are being sponsored or raising money from JP Morgan Chases of the world, they may be okay to overvalue Twitter because they're looking at getting a deal on SpaceX, right? So that's my concern. Whenever I hear about the Twitter valuation, I don't believe this. There is a lot of other stuff that goes into that, right? If it's private one, you never know what's in it. Sam said, I'm thinking of buying BYD versus CRM ADBE. As long as if you're comfortable with the business, go ahead, all powers to you. I think I have a BYD. If I can find it at a cheaper price, I'll buy it, because BYD is not optionable. That's holding me a little bit back on it. I don't think CRM I'll buy it. Adobe maybe, but probably not. Yeah, no. BYD I'll be if I can get it at a little cheaper price. Original investors out, Twitter sold to Musk AI. This is all XAI and everything. This is all Elon's business. You can sell one business to another one. You are on the both sides of the party. Value whatever valuation you want to do it. Who cares? You are the buyer, you are the seller, right? Doesn't matter whatever valuation you give to it. Niyanka is saying, if Elon meets the board expectation, would it be diluting the current shareholders big time? Sure, I've not gone to the proxy and looking at, so it'll be another $400 million of, are these the new shares, or are these the shares which already have been approved? I don't know. Or is it new ones that the company will have to raise? But overall, $8.5 trillion market cap, I'll be okay with it. All right, let's move on. Enough on it. Tesla and Elon is the topic which we can talk all along. One thing is, whether you like it or you hate it, you cannot ignore it. Right? That's what the Tesla will be. You can't ignore it. There are passionate people who are investors in Tesla, and there are passionate short sellers in Tesla, but Tesla is always in the news. Right? So while we're talking about robots being delivered, I don't think they have made even a single Optimus that has been delivered. In China, there are humanoid robots that are available for, you go to a mall. There's a new mall that opened up in China. I forgot. I don't want to read the whole article again, but I forgot which the place was. You can go purchase a humanoid robot or rent it or customize it, saying I want these customizations. So a lot of companies in China are way ahead. Companies like Unitree, there are a few other companies that are building humanoid robots. These humanoid robots participate in marathon, they're participating in other sport events, etc. Right? So if you're thinking Optimus is the only one, no, Tesla is, I would say, far behind in the game for now. But a lot of companies in China are already far ahead when it comes to humanoid robots. Even in US, I think Figure is also working on humanoid robots. So it's not a winner take it all or Tesla take it all market, as some of the Tesla's ardent bulls will let you believe. We'll see what happens. At the end of the day, if Tesla goes to $8.5 trillion, I'll be happy investors. Next one I want to look at is Lululemon. Right? Had a really, really tough time. If you're a Lulu investors, it was a week that you would really like to forget about quickly. After the earnings, the shares were punished. I think they were down 15, 16% or something. So I went back and looked at last 5 years. So last time the stock traded at close to 165 was in 2020 April. It's almost 5 years and no gain if you held a Lulu stock. So it's like a half a decade, lost half a decade for Lulu. What's happening? Is it a value play or a value trap? I know that now suddenly you see a lot of articles or the research reports coming out arguing on the both sides of valuations. Is it a trap or it's a value play? Should we buy? Should we not? Sorry, I personally have never owned a Lululemon stock, but last Sunday, previous Sunday, it was the first time that I went into Lululemon store in San Jose on Santana Row. My wife was doing some shopping in another store. So opposite to that, there was a Rivian store. I thought I'll go and just go and see Rivian and some of their vehicles. And near to that, there was also Lululemon store. I walked into Lululemon store. Maybe I was looking for some athletic shorts. It's like $60 for an athletic shorts. I'm a cheap guy. I'm like, I'm not going to buy and pay like $60. Now, of course, there were other overpriced leggings. I went there for like boots on the ground kind of a research, looking at what other customers are buying. Majority of them customers were young adult females, maybe from, let's say, high schoolers to mid 35-ish kind of a stuff. Store wasn't overcrowded, right? It was not that they were falling over each other, or it wasn't too crowded as well. So it was a very thin crowd, but mostly young adult females. And of course, I think I was probably, that's not a place where I would shop. I'm not going to pay like $60 for athletic shorts, right? Even I went to the discount rack. Even on the discount rack, right? There's nothing less than $50, right? So call me cheap, but I thought I went and did my research. That's my only boots on the ground research, that I actually visited a Lululemon store last Sunday. Then I asked my daughters, I'm like, hey, you girls don't shop, or your generation doesn't shop there anymore. And some feedback that I got was a couple of other brands where say mid-20s or mid-30s ladies have moved over to, and they say there are similar upscale brands which now girls go and buy it there. So maybe looks like I'm not the only one who is not shopping there. There are the target segment of Lulu have got other options as well, and that's what may be bringing this down. So that's on Lulu. And like I said, I've never owned the stock. I've never done a deep dive research on the stock. Like last week, we did a deep dive on DoorDash and never touched on it. But I went back and quickly looked into the quarterly numbers to see where the numbers look out to be, right? So over the last, clearly you can see that over the last, 3 years, the growth rate from the revenue perspective has been slowing. It is still growing, but not as the pace that it was growing earlier. Right? Looking at a 5-year CAGR, it was 23%. Come closer, 1 year, year over year, it grew only 7%. Right? Or 3 year, it is 11% growth. So clearly the growth is slowing down. Margins are still able to maintain the margins. So close to 60% gross margins, mid-20s operating margin. That's fine. I would draw your attention to some of the valuation, right? Right now, if you look at it, it's probably from a valuation perspective, either you look at price to say, not valuation, but from a pricing perspective, price to sales, price to your earnings, or free cash flow, which is a metric which I want to focus on, probably cheapest one, right? It's looking at almost 19 or 20 price to free cash flow, means your free cash flow yield is close to 5%, right? Not as good as what once Alibaba was, but 5-6% free cash flow yield is pretty decent one, right? So the question is, if you understand the business, right, this may be a time to look deeper into Lululemon, because from a valuation perspective, from pricing perspective, it is available at a much cheaper price. Sure, the business is facing its challenges, but sometimes the market also, market generally, the pendulum will swing to the extremes on both ends. Market will suddenly sometimes overprice the stock, suddenly it will punish the stock. So if you understand the fashion side, one big reason why I never invested in this is, from my perspective, and that's the reason why I also don't invest in, let's say, flavored drinks, etc., is consumer taste can be fickle. That's why I'm not invested in, let's say, Birkenstock or some of those fancy new shoes that have come in over the last 2-3 years, like Allbirds or something like that. Consumer taste can be fickle. Fashion trends can change quickly. It is very difficult to build a stable, long-living brand. There's a reason why we have only Coke and Pepsi, even though there have been challengers, over the years. But there's a reason why there are only two big recognized brands, right? Coke and Pepsi. It's difficult to build a new brand on this one. So that's been one reason, and I don't understand this whole fashion industry closely. That's one reason why I've been staying away. But just from a valuation perspective, that looks to be pretty attractive. If you were willing to buy a Lululemon, let's say 6 months ago, now this is much better. Looking at annual revenue, same case, right? We're looking at of course, this is only till end of 2025, so now it is available even at a cheaper price. So after looking at the numbers, I also ran it through my business metric to see, is it a great business, right? It's not too bad. This I was surprised to see. I mean, it's a decent business. The stock fell down because of the guidance. So the numbers will only tell you one half of the story, which is what has happened in the past, how the management has behaved, how the business has behaved. But when you're investing, you're investing mostly for the future, right? What's going to happen in future? But the past will tell you something about how the company has gone through different business cycles, how the management has, created value, etc., which give you a little bit of confidence. Future is all about narrative, which I don't have much idea about the narrative around the leggings or the fashion side, which you need to bring in your narrative. But from numbers perspective, not a bad business though, right? 60% gross margin, they don't pay any dividend, but they've been buying back the shares, right? Close to 2%. And over the last trailing 12 months, they bought back 4% of the shares, which is great. Mid-teens 20s operating margin, mid-teens profit margin, revenue had been growing at a much faster CAGR than over the last 1-2 years, which will tell you why the market is punishing the stock, because its growth is slowing down, right? But other than the growth slowing down, other metric looks okay. It's not a broken business, but it probably will not command the same high valuation what it used to be, but it's not a broken business, right? So it generates decent free cash flow free cash flow yield is now, or trailing 12 months is around 5%. So not too bad as a business. The bigger question is around, from a valuation perspective, is it a right time to buy or not? More important is, do you understand this business? Do you want to be associated with this business? Do you want to have this business in your portfolio? Right? I don't think I'll be willing to, as a long-term hold, I'll be looking at Lululemon, maybe trying to swing something just because market has punished it more than what it deserved. Could be, but I don't understand the fashion industry, so I will stay away. But this looks compelling if you understand the industry, and if you had studied Lululemon, the current valuation, the current pricing looks pretty compelling. So I thought I'll bring it up. Even though I don't own it, I don't think I would want to own it, just because this industry is difficult for me to evaluate or keep up to date. So that's Lululemon. Anyone, any shareholders of Lululemon here? Let me ask that question. Maybe I should have asked that before digging into Lululemon. Anyone owns Shri owns Lulu? Oh, do you own the direct shares or just option position, Shri? Options delta or actually the share deltas? Shares. Cool. Anyone else on Lululemon? No? Maybe if you want to, you could look at this, but then you also need to be aware of, there are many businesses. So I pulled up, I think some point of a time, I had created this list called Fallen Angels. I added Lululemon to it now. Like today morning, I added Lululemon, like Lululemon, XYZ, Dollar General, Alibaba, PayPal, Southwest. Just the great companies, right? The good brands that we all are aware of and have used. Intel, the storage engineering company, Estee Lauder, right? Starbucks, Nike. Many of these are going through the tough times when it comes to the stock price. I would say also the business side of it, right? UPS is having tough time. Target, after the earnings, Target had its tough time. Nike probably haven't done much over the last, after the whole China, etc., they were having tough time as well. Looking at last 5 years, returns are like negative 34%. Right? So these are some of the storied brands. Some might be a bad stock, but okay business. I don't think any business we can call it as a great businesses, because if the businesses were great, market wouldn't have punished it. But could be possible that the business is okay. I think the challenge is to identify those which are the businesses are still okay, but the stock has been broken down. The idea is to find broken stock with okay businesses. That will give us the edge. So looking at, let's look at a performance, right? Pretty bad. Like PayPal is down 65%, Estee Lauder 58%. That's all China. Lululemon 53%, Alibaba 50s. The question is, has market punished it more than it should be? Look at their operating margins, cash flow. Do your own due diligence on these. Sometimes you can find much better deals in these stocks because these are known brands. If the problems that they're currently facing, if the management can overcome those problems, market will come back and revalue it. Right? So again, some more ideas around the fallen angels. If you want to looking for something to add to your portfolios. Shri Singh also bought Leaps. Santa say a couple of debit spreads for earnings play. Earnings is now over. I don't know. Did you have a delta neutral or did you have a bullish or bearish play on Lulu? Sam said discussion why Pete's in San Mateo counties are compared to the premium Shanghai and still better So Starbucks needs to give value to customer, whether Taco Bell is doing as well. Yeah, I never invested in Taco Bell. Sanda says neutral, but the stock was down 16%, so probably this is challenged. Rohit has to go for grocery. All right, good to see you, Rohit. Food is more important. All right, so what else happened this week? Again, S&P 500 committee decided to change what they constitute as a S&P 500. So we saw a couple of them get in. Robinhood or the Twitter. No, now it is X, right? I always still call it Twitter. It's X. So X blew up because there are a lot of ardent retail investors who love Robinhood, and finally, they got what they were looking for. Robinhood has been included in S&P 500 index. Also, the other one, which is AppLovin. These stocks have been doing great over the past 1 year, and so not surprised that now finally they've been included. Of course, S&P Standard & Poor's, they have a criteria based on which they will add the stocks or take the stocks out from the S&P 500 index. The reason why the stock market on a temporary basis will reward any additions, etc., is if you are a part of S&P 500 index, lot of a passive wealth is gonna come into your stock, right? My biggest holding is S&P 500. Most of the retirement portfolios, if you haven't touched your retirement portfolio and you've stayed with the default, which will be, let's say, your age-based retirement, if you're young, most of it going into these S&P 500 or equivalent funds, right? So a lot of those, every 2 weeks, millions and billions of dollars will quietly flow into S&P 500, and then basically that end up into buying the individual shares of the constituents of S&P 500. Actually, there are 503 shares. I don't know why we call it S&P 500. I think it's easier to remember. So you will see inflow coming in here, and that's what the market is trying to front run this. And the Robinhood stock was up, I guess, 6, 7, 8% on the news that has been included in S&P 500. Right. Let me just pull up what's the Robinhood stock date. Was up 6% after hours once the news came out that is being included in S&P 500. Right. Now the questions, and again, I don't have Robinhood in my portfolio. I don't think I'll be adding it to my portfolio. And my investment thesis is never based on whether it's going to get added into the stock or not. There was a study that I shared earlier, which was how some of the stocks have performed 12-year, 24, 12-month after they've been added to some of these indices, right? They actually have trailed the market. Because, market will push up the prices in anticipation. So you're already start to overpay for it. So your thesis should not be, I'm going to invest once it gets added to S&P 500. You might already be late. On an average perspective, I'm not saying Robinhood or AppLovin you're late, but if your investment thesis is going to add, now I'm going to buy XYZ. I can't use example XYZ anymore because now, damn, block, you change your ticker to XYZ. Let's say ABC, right? If you want to buy a stock ABC, because now it's got added to S&P 500, maybe think again. Across all these additions, the market is not favor of buying it after the addition. Okay, it has underperformed the market over the 12-month period. There was a study, I think, a while back I showed. So, but if you like the Robinhood as a business or AppLovin as a business, then this changes in S&P should be immaterial to you. Other chart. Hedge funds have been cautious on US stocks since the July end. the money flowing into passive and active US domiciled funds from the hedge fund actually fell below zero. Just because I think hedge funds are a little concerned about the seasonality. And this is where monthly average return from 1980 to August 2025, almost 45 years of history, September has been a red month on an average. No surprises that hedge funds, they pulled out some money from the markets. And sometimes it also could be, self-fulfilling prophecy, just like inflation is. Because historically September has been not a great market, and hence the funds will pull out, so which will bring down the if you sell, it'll also be negative to the market, and hence the September will never be able to change the color from red to blue. In any case, it doesn't really matter. It's just 1 month. I'm not making any changes because I'm not I don't have to perform month to month or quarter to quarter or year to year. Who cares what happens this year? But that could be a reason why some of the hedge funds at a net level, we had an outflow from hedge funds on September so far, because in preparation for a September volatile month, which generally on an average has been negative, hedge funds may want to deploy their capital to other markets. Right? So this is what the seasonality of September is. It's been a negative month. A couple of questions I see. Jose says, check out VF. VF is a Levi jeans, right? Another retail turnaround.
No, it's Vans. The shoes.
Oh, it's a Vans. Don't they have one famous jeans brand as well? I mean, I'm aware of this company. But yeah, investing into these brands of the fashion, I just don't have a good way to evaluate this.
I don't know. I was just looking at it a long time ago. And
maybe there should be an ETF which invest on these brands, like fashion brands. Maybe I'll found that, because rather than staying away, maybe that might be a way for me to get an exposure just through an ETF. Albert says, oh, Lulu seems like a flash and crash stock. Kramer said Costco is selling similar quality products at fractional Lulu prices. Maybe Lulu has had its day. I'm not sure. I mean, people go to Lulu for its brand, and if their brand value has deteriorated, then yes, I may be concerned about. People who want to wear Lulu, they don't want to have a Kirkland showing up on the leggings or pants or whatever the Lulu sells stuff, right? It's a different genre. I'll be okay to flaunt Kirkland, but the people who shop at Lulu, they probably don't want to. So I don't think I don't subscribe to Kramer's view. Because sometimes people shop not just because it's the same quality and different price, just because they want to see them. They want others to see them associated with that brand. That's where the branding comes out to be, right? It's all about the brand. Utility value, I understand. Costco probably provides the same utility value, but Costco doesn't have the same branding stuff. Bhavya, do we also talk about crypto? Yes, I will talk about crypto. Promising altcoins. I'm not a big fan of altcoins though, but if you have something, pick it up. EMC MCore is also added. I mean, there are a few other companies that got added, but these two were the retail favorites, and retail I've been waiting for these to get added. Rajiv is saying USD index showed 50-year record decline in 2025 in the end of June. I'm not sure exactly what that means. Lulu is more like LVMH. It's a lawsuit with Costco. Or maybe, okay, so Lulu could have sued Costco. Any analysis on eVTOL industry? If you want to invest in eVTOL, go with a venture capitalist mind. Right? There's not much analysis can be done because the business is a very nascent stage. It's all about the story of a future. Some of the companies are public, which I don't think why are they are in public market. So that's like 30 seconds of my thoughts on eVTOL. Spray your bets because you don't know which one is gonna survive. This is a very nascent industry. It's a lot of activity happening in this industry, but it's a very nascent industry. You never know. There's a lot of regulation. There's a regulatory aspect for it. There is an operational aspect for it. And who can survive in the long term, right? So go with a VC mindset, invest in more than one, spray your bets, and then pray, like spray and pray that some of them will survive and make you money. If you want to invest in eVTOL, this is how I would say to go that way. There are some companies which are in this. You got a Joby Aviation in this. You got Xpeng in this. There is another, I think, couple of Chinese companies with a E-Hang or something, which is in this. So maybe spread your bets. For now, it's a very nascent industry. All right. While we've been talking about these exciting companies, gold hits a new all-time high above 3,600. Looking at a GLD, GLD is up like 35%, like 34.9989%. GLD is up 35%. It's been a massive run up in gold over the last 2 years. I should have listened to my wife and should have bought a lot more gold, right? But I'm not the one who's going to invest based on what happened in last 2 years. If you look at it, and this is where pull up GLD. Oops. GLD, right? Insane year to date. 1 year, 43%. Go back to, prior last August. 5 year, 82%. Right? So, but look at gold. Only started, it had a huge run up only from 2023 onwards. It's only the last 2 years of gain is what has caused gold. So if you really want to invest in gold, I would like you to look at the longer term trajectory of gold. Right? It's from 2011 till 2022. Gold had 11 years of no return. Right? GLD is at whatever, 170 or plus. It's still at 155 in end of 2022. It's only over the last 2023, 2024, you see this run up. Right? Now the question is, will this continue or will this not? I'm not going to change my thesis based on what's happened over the last 2 years. Hold on. Let me delete. Okay, just give me a moment. Okay, so I was seeing some annotations. Just had to take that off. So you determine. Do I hold gold in my portfolio? Yes, but I didn't buy it in 2023, etc. Or in fact, I actually sold a little bit in 2020, I think 2024. But what do I know? Nobody knows. I did not know that gold will continue to have so much of a run up. Again, gold works well when there is a fear in the market, when the fear around the sovereign stuff, right? That the governments have gone crazy. They've gone bonkers. They don't know what they're doing. For me, I moved more towards the digital gold, right? IBIT, etc., than on GLD. So while I sold GLD, I added more on the IBIT side. So you determine what you want to do, but it's not that any asset has always performed. These last 2-3 years have been great. And also what's been great is a lot of central banks have been buying gold. So I think after many decades is the first time that the central banks collectively have more gold as a reserve asset than US Treasury. And we shouldn't be surprised on this information because, as a government, we haven't been the best in last, let's say, 4 or 5 years. We've been like spending money like crazy drunken sailors. Right? Then why would other countries want to hold our treasuries when we are not shown fiscal prudence? So a lot of central banks have been buying gold. And that's the reason why the gold has gone high. Could it continue to go high? Maybe, who knows? Future is uncertain. Okay. Okay. There was comment, why do what I bought instead of gold? So basically, IBIT is an ETF on Bitcoin. Again, I'm not telling you should buy it, but I would rather have that because the new generation, right? The next generation, anyone below 30, ask them investing in gold, they look like I'm a dinosaur, right? But they're very comfortable in trading or buying this other crypto related stuff. So I'm looking at for next 20 years, maybe digital gold, which I do consider that still Bitcoin story is store of wealth, and I would rather store in that than in gold.
Wait, why not buy Bitcoin directly?
You can buy Bitcoin directly as well, but then you also need to make sure how do you safeguard it. Keep it on an exchange, your exchange get hacked. Keep it on offline device. Then you have to take care of your seed phrase and all that. You can do it. I mean, I've covered some sessions on the different level of security versus accessibility ease on how do you store/protect your crypto assets, not just Bitcoin, but anyone else. Yeah, you can do it. But if you buy let's say through these ETFs, now because these ETFs are available, right? Prior to 2024, you have no other option but to either buy it on a crypto exchange or to buy it and then move it to your offline cold wallet. But now there is an option. And if you're not 100% libertarian, if you buy IBIT, it falls into your current financial life very easily. Right? You don't have to make any changes. Let's say you moved into a cold storage. What if you come under the bus? That's stuff which has been lost. Right? If your heirs, your family doesn't know about it. So from that perspective, yeah, if you buy it on these ETFs, your rest of your financial life is just, there is no change that you need to do. That's the reason. With an ETFs being available, I have just moved over to buying on an ETF. That's the reason. And, of course, I pay a little bit of expense ratio for it, but it's too much. It's convenient. It falls into the way the financial life is. I don't have to worry about dominations, etc. Everything is already set. And don't underestimate the power of simplicity. That's the reason only after the ETFs are coming, I became more bullish, because now the pension funds, etc., they can just allocate to ETF. They don't have to change their charter, etc. That's the reason. We can always debate. You can go to the multi-sig partners, etc., but additional stuff. All right. Looking at fear and greed index as of Friday, and we are still in a neutral. So I'll wait and watch, not adding too many deltas. I am That's my standard stuff is look at morning every day, look at, did I lose deltas? Did I add deltas? Do I need to add deltas to my portfolio or not? If the dial move towards fear, I'll be willing to put little more bullish trades. Right now, I might be just doing a delta neutral one or might probably do a delta negative trades. Sector performance, yeah, S&P 500 10%, not bad at all, except the healthcare. Every sector is right. So that's why it pays to stay invested, right? Not get scared out of the market. Buys and sells this week, I only bought TLT, which is long-term bond, 30-year plus, 20-year plus bond ETF. Other than that, nothing else. So that's on equity side. Looking onto the crypto side of the house, today morning, as of today morning, total market cap close to $3.9 trillion. Bitcoin has been floating between, I would say, this whole week, 107 to 112, right? Little low, less than what we had seen earlier, but who cares? 110 is still fine. I mean, this is a long-term play. Won't be surprised if it goes down to 90. I mean, we have seen this asset is pretty volatile, even though the volatility has come down because a lot of institutional investors have moved in. But still, I won't be surprised if it breaks down like 30%. So if you are in any of these crypto assets, be ready for that 30% drawdown. We have a 30% drawdown in our stocks, so forget about cryptos. Cryptos is generally more volatile, right? Some news around the crypto side. SEC, again, this is where I want to focus on not just the pricing, but I want to focus on what's happening in the ecosystem, right? I was watching the markets, I've been talking about it, and when I realized that the BlackRock had filed for ETF in 2023, we came and talked about it, right? Guys, it's a time that now when the BlackRock is filing for ETF, you know that institutions will come behind this asset class. BlackRock had a 576 versus 1 in terms of their approval against SEC, right? For 10 years, SEC did not approve any of the spot Bitcoin ETFs. But when BlackRock filed, they own SEC. So the flood of money will come in because it will get approved. And that's what we saw in January, right? So I want to focus on what's happening more in the industry than what's happening on the pricing. So we saw SEC had overhauling. Basically, they're going to overhaul the rule, the agenda, rulemaking agenda around crypto. They are looking to change rules around how the traditional exchanges, let's say Nasdaq and NYSE, how can they start engaging in this new asset class, which is crypto? What will be the safe harbors? How can they offer the buys and the sales of their crypto assets on traditional exchanges? Today you can buy all other asset class. You can buy bonds, you can buy tokenized gold, you can buy gold ETFs, which is kind of a tokenized IOU on gold. You can buy stocks. Why not crypto? Because we never had a rules around how the crypto exchanges, how the stock exchanges should integrate. But now the SEC is working towards it. The plan is to propose a rationalization of disclosures to increase transparency, etc., which has been one of a big, I would say, the concerns of lawmakers have been this has been a completely opaque space. It's in all scammers, etc., etc. Right. Also, we had an Ethereum that hit 2025 new all-time high very recently, last week, and then not as pulled back. Other big stuff that we saw, and which if you are investing in any of these crypto treasury, digital asset treasury companies, your portfolio probably was in red because Nasdaq overhauled their rules around their listing requirements, especially for companies that are becoming a digital asset treasury company. So over the last few weeks, I've taken you through the list of the announcements and the companies that are just raising funds to become a digital asset treasury companies. So this week, Nasdaq came up saying, hey, we're going to put some brakes, apply some rules. Some of the rules are related to how much is the minimum public minimum float would be, how much is the minimum offering, etc. should be. If you're if you're basically selling a new shares just to buy crypto assets, you need to get a shareholder approval, etc., etc. So that caused a big sell-off into these digital asset treasury companies, Bitmine Immersion, BMNR, MicroStrategy, MetaPlanet, which is a Japanese company, but trades on OTC, SBET, which is Ethereum treasury companies. They were all down there are others also which were down like more than 10, 15%. Because, hey, Nasdaq is tightening the rules. And if you don't follow these rules, they will delist you. So that was one big, I would say, little shake up in the market on the crypto side. And finally, I saw a tweet around the whole MSTR. This is one reason why I'm not invested in MSTR, because the math doesn't seem to be mathing. MSTR hit an all-time high in November 20, 543, which is true, when BTC was at $94,000. At the time, MSTR had 330K of Bitcoin on its balance sheet. Now it has got almost 636,000 Bitcoins, right? Bitcoin is up 19% since then, because Bitcoin is up close to 110K, whereas MSTR stock is down 40%. What gives? That's a question now people are asking. If you're investing in strategy because you're bullish on a Bitcoin, you paid up. I mean, there's a whole concept of MNAV, etc., that we have discussed. And I know Saylor is talking all the financial engineering around why it is great. But if you thought if Bitcoin goes high, MSTR should follow it, you've been deeply disappointed. The math isn't mathing. Though the Bitcoin is up 20%, if you're held MSTR shares, it's actually down 40% since then. And I don't care what Saylor says that you own more Bitcoin per share, etc., whatever it is. If you're gonna go to Michael Saylor and say, okay, take my shares and give me the Bitcoin, you're not gonna get that, right? But all you can benefit by buying MSTR shares is what the price at which MSTR share trades, and which is now 40% lower than where it was. So you would have been much better by buying Bitcoin and in November than buying MSTR. Okay. All right, so that covers overall at a high level. Now we're going to jump into the fixed income investing, which will be the big topic for today, and then we'll break out into different breakout rooms. Meanwhile, any other questions? Let me go through some of the chat and see if there are any questions that have been unanswered in the chat. People talking about Lambos here. We are dinosaurs. Central bank, yes. Bhavya says buy BTC on Robinhood itself. I'm not a big fan because I think you don't get the best pricing, but who cares? It's a lot convenient to buy it on Robinhood. Oh, Okay, what did other buys and sells? Question, Alina. Any inputs on Palantir and Nvidia? I mean, I've talked about Palantir many times. I like the business, not the stock price. So if you're buying Palantir right now, you just think there are more foolish people who will take it up from you. It's one of the most egregiously priced stock. That doesn't mean that the stock won't go higher. Right? I like the business of Palantir, but the stock business had to perform to the level at which the stock is being valued. So I'm not going to buy it. Not that I'm selling my remaining ones. I have a collar position on it just to protect my gains. And if it goes to 175, I will be done with my Palantir in my portfolio. They will be called away. I'll have no qualms in letting it go at 175. But if it goes below 135, I have 100% protection. So all I'm doing on Palantir is now trying to protect the gains. Because I still think it is still very egregiously priced. Mike bought a lab, Astera Lab, sold Meta and App. So TLT will rise at rates are cut. So if the 30-year comes down, which is not driven by Fed, but if 30 years come down or 20-year bond rates come down, yes, then the TLT will rise. My idea of TLT was just that I wanted to get to a round number of my holdings. That's why I bought it. If I already had a round number in my holdings, I wouldn't have bought it. Very small addition just to get to the round number of holdings, stock holding in my portfolio. Then I can continuously sell, I think I have a strangle on it already.
Very quick question.
Yeah.
Regarding Palantir, you mentioned you have set up as 175 as take profit, 135 as stop loss, it seems, right?
Yeah, basically, yeah. Bought a put at 135, sponsored by selling a call at 175. This is what this is a collar trade is. You put a collar around your current position so that if it goes below 135, I'm protected. But if it goes 175 above, I'll have to sell my shares at 175.
Got it.
I'll be okay with it. Yeah.
Okay, thanks.
Yeah. So sometimes, I've talked about the collar trade is sometimes if you think you have had enough gains on some of your holdings, Palantir has been a great winner for me. We talked about it when the stock was at $7 and I said, this is undervalued. Again, I was comparing business and the stock price. Once the stock price became above 65, I'm like, it is overvalued. Above 125, it is overvalued. And, but who knows? Market can continue to push it higher. So, and I've been selling some of the portions and I'll be pretty happy to sell the remaining at 175. Right. Mike says we're nibbling each week on Nvidia, buy each week over next 2 months, etc., etc. All right, too many comments. Do you think that CRWV is also high price? CoreWeave? I've not looked at the pricing on the CoreWeave just because I'm not too comfortable in the long-term viability of the business of CoreWeave. And also how if you go through this S1 of CoreWeave, which we detailed in our meeting, look at the risks or the red flags that I found while going through its S1. The whole relationship between the magnetar and the CoreWeave, it's like too complicated. It's like a spaghetti of how the company has been formed. So I'm not too keen on it. Short term, it's a great business because there is so much demand of NVIDIA chips that if you own NVIDIA chips, which CoreWeave did, because they wanted to use it for the crypto mining, and when the crypto stuff became it cooled down, they shifted over to AI side. Business is doing great. But you got one supplier. You have an asset which depreciates it at a faster rate because once your Blackwell, Rubin chips come in, then your Vera chips come in, your H100's value gonna go down. Fastly depreciating asset, one supplier, and few number of customers that you can count on your hand. Hyperscalers, neoscalers, right? Is this a great business? And almost no moat in the business, right? So from that perspective, I'm not too bullish on CoreWeave as a long-term viability. Short-term, because of all these NVIDIA AI chips demand, yes, probably they'll look good. But I'm looking at something which, can I hold it for next 20 years? So far, CoreWeave has not crossed that threshold. Also, if I look at numbers, etc., not that great. Next 4 years, 5 years, AI demand continues, sure. So determine your investing horizon and then see if you want to take a position. Avgo, which is Broadcom, is a formidable challenger for NVIDIA. Yes, if you're looking at almost like Amazon is coming with their Infrenium and Trainium chips. Google already have their TPUs. Microsoft is working on their own stuff, and eventually they will do their ASICs, and Broadcom is the king of ASICs. Right? Is it gonna, displace NVIDIA completely? No. NVIDIA probably could come back and fight, because if you look at the NVIDIA's financials, I mean, they got a lot of margin, right? So they're not going to sit back and let Broadcom take away the shares. I'm sure there is a space for both of them. And of course, NVIDIA has got the whole ecosystem around CUDA, etc., which is not easy to replicate. All right, so let's move on to the fixed income investing. Probably spend half an hour on that, and then we'll break out into different breakout rooms. We could talk about stocks or options, whatever else you want to talk about. Okay. All right, so let's get to where's the fixed income. Oops. All right, starting with the easiest part. So fixed income investing, as the name suggests, is your expectation is that once I invest in this, I'm going to get a fixed amount of money, right? Stock, if you're a shareholder, there's nothing fixed. Stock price could go up or down. You can stay negative. We have seen with Lululemon for 5 years, holding Lululemon share for 5 years, you got nothing, right? So if you're feeling a little jittery, you want to bring a little more stability on your portfolio. And it's not a bad thing to look at some fixed income opportunities, especially given the fact that over the last 2 years, since 2022, Fed have increased the interest rates. You actually can get paid okay amount in fixed income instruments also, right? Prior to that, if you invest in CDs, so the easiest one is the CDs. If you invest in CDs, you could hardly make 1%, 2% for holding the CDs for 12 months. Now you can actually get some decent interest rates of 3%, 4%, because the Fed funds rates are higher. So something which most of us should be familiar with is certificate of deposits. You basically go and open in your bank account, in your bank, you commit to deposit that amount, let's say $10,000, $5,000, hold it for 12 months, you get paid a fixed interest. This is the easiest form of fixed income, right? It gives you predictable income stream. You're going to make 4%, right? As long as the amount of the money that you invested is within the FDIC limit, this is almost zero risk. Government will come and backstop if the bank goes under. So you can find CD rates, etc. on bankrate.com. Look for it. Marcus Goldman Sachs, they are giving like 4.15%. right? For 13 months. You can open a 13-month CD, get 4.15%. It is protected FDIC protection, so don't have to worry about the bank going under, etc. Morgan Stanley has got 4.45%. Go and do a research. There are much better options available. Second is the money market funds. So money market funds is generally, if you move your money into, you would see, let's say if you're owning Fidelity, when you transfer money into Fidelity, their core holding is that they'll hold your cash into the money market funds. Right? Money market funds pay a little bit more than the CDs because money market fund managers will generally invest in US Treasury bill, commercial papers, corporate commercial papers, some CD, etc. Again, fixed income. They invest in these instruments, try to give a little more yield. So you got a Vanguard money market fund, you got a Schwab money market fund, Fidelity money market fund, SPA, XX. The yield may not be accurate in this table, but it's generally higher than, let's say, 12 months yield on a certificate of deposit. Now, depending on another additional benefit is depending on what do they hold in its portfolio, the earnings from the money market fund, if they hold US Treasuries, you'll not pay any state and local income taxes. In a CDs, you pay all kind of taxes. This is like your ordinary income. But if you're having, let's say, Treasury money market fund, then it's only tax at a federal level. There is no tax on state and local tax level, right? Again, very safe. Generally, the money market funds, the value doesn't change much. If you invested, bought it at the price stays close to $1. Except in extreme cases, like in 2008, we saw some money market funds depeg from $1 value. But since then, the government has mandated more stringent rules on where the money market funds can invest in, so that it never changes, it stays at $1 value, right? So avoid risk. Again, this is a very risk-free way to get a consistent interest income. Money market funds is another choice. You can buy this on your brokerage platform. Money market funds can also be collated for selling CSP puts. Yes, this is a part of your, I think it will add to your buying power if you're holding a money market fund because it is in your brokerage account. You got a JP Morgan, Morgan Stanley, all big financial firms that we are aware of have their money market funds. Third one, which not a lot of retail investors invest in, I have not invested in any T-bills until 2022 because that's when the Fed started to increase its interest rates. That was the first time I had invested it in T-bills. So that's where I learned that all these are the same. Bill, notes, and bonds only means there's a difference in the durations. So T-bills are again government, US government. These are backed by US government. This is basically you're lending to US government. So it is as safe as the US government is, which so far it's still considered as the most riskless government borrower we have in the world. I know the risk has increased a bit from what it used to be, but still this is the most risk-free government instrument that you can get. So T-bill, T-notes is from 2 years to 10 years, and the T-bonds is 20 years to 30 years maturity. One thing that you need to worry about is if you buy this T-bill, T-notes, T-bonds, you buy it with an objective of holding it throughout the period of them till maturity. Don't do what some of these banks have done in 2023 or 2020. Yeah, banks have done in 2022, 2023. And then they went under because they were holding T-bonds in their portfolio, which is little irony, right? This is the safest instruments, and the bank had to declare bankruptcy because they were holding most of these safest instruments on their portfolio. The risk that you run up in holding this is, depending on the interest rate, the value of the T-bills that you hold in your portfolio, the current value could fluctuate. And this is what happened in 2022 when the Fed started to increase the interest rates. All the banks that have held the treasuries and the bonds on their balance sheet, the value of those started to come down. But if you don't have to sell, who cares? That's why I'm saying if you want to invest in it, make sure you can hold it through the maturity period. But some of those stupid banks could not hold through the maturity period. The value of the treasuries on their balance sheet came down, their assets came down, and then, they had to basically, their asset debt liability mismatch happens. There was a little concern in the market. We saw that it had a bank runs, and then the Fed had to step in to rescue those banks. But if they were able to hold it till maturity, you will get your committed percentage. Let's say if you're buying a T-bill and the T-bill current rate is, okay, I don't have it here. So let me, so let me go to the Treasury Direct and see what the T-bill rates are. You will get paid that rates, but the value of the holding could go up and down depending on the interest rates. If interest rates goes higher, the value of your current holding will go down. If interest rates goes lower, the value of your current holdings will go up. But if you don't have to sell, you care the least what the value is. You invested in it so that you can get a fixed income coming here, which you will get. Okay, so be aware of interest rate sensitivity and match your time horizon, which some of those bankers did not do it. What is the risk? Of course, you have an interest rate risk that I talked about it. Loss of purchasing power, right? Maybe it will not give you as much as tips or as much as inflation. Then you can try the Treasury inflation protected securities, which will at least give you a little more than what the inflation rate will be, right? So you can invest directly through treasurydirect.com. www.treasurydirect.com. SURY direct. Come on. Direct dot, I think is go. Let's check it out. Or you can buy some of the ETFs that invest in it. Yeah, it is Treasury Direct. Right. So let's say look at the recent auctions. Where's the recent auctions? Recent auction results. 20 most recent auctions. So you had a 4-week T-bill. It's paying 4.2%. T-bill for 1 year is paying 3.8%. And this auction happened in 2 or 3 days ago. You move over to the notes. 2-year note is paying 3.6%. 7-year, etc., etc. Move to the bonds. You can do this. Move to the tips. You can do this. So you can invest, create an account, link your bank account, invest directly on this, but make sure you are able to hold it till maturity. Otherwise, you will see the value of your holdings going down. But if you can hold it till maturity, you will get whatever the 4%. Or you can go and use any of the ETFs. There are many ETFs available. None of these are recommendations, but this is the sorting of the AUM based. So I asked some of these LLMs to give me a list based on the AUM. So if they're hallucinating it, make sure to check the data. BND is a Vanguard Total Bond Market. It includes a maturity of all different levels. AG is a aggregate bond market from iShares, which is BlackRock. SGov, 0 to 3 month treasury. It can't be a bond. It will be treasury bill ETF because 3 months is treasury bills, right? TLT is 20 plus year, which is what I own in my portfolio, so on and so forth, right? I also, for short-term perspective, when I have a cash, I move into ICSH. ICSH ETF basically holds treasuries plus corporate bond. So it will able to give a little more higher than what the treasury has to offer without adding too much of a risk in it. Right? And I own ICSH only for as a way to park the cash. My idea is not for, if I don't need a cash for next 2 months, I don't want to move it to the CD and all that. I'll just move it into ICSH and hold it for next 2 months, 3 months. And I come and tell you, right? Like last week, I told you I sold some ICSH because I had a bills to pay. So yeah, so this is what I use. I don't own, I own TLT. Other than that, I don't own anything else. But my favorite way to park the cash. None of them are good or bad choices. All depend on what kind of a duration you're looking for and how much a risk you want to take. Right? Third one, which is a corporate bonds. So corporate bonds are the bonds which companies will issue. Right? Companies need to raise money. They need money. Let's say you want to set up a new plant and you raise money. There are two ways in a company can raise money. They can issue more equity, dilute their shareholders, or they can go to the debt market and raise money through the debt market. This is what a debt market is. When the company basically issue the corporate bonds to raise money. Some of the companies can raise money even at a better rate than what the US government can, because the world understands that they are better financial managers than what the US government is. Like companies like Apple, right? Apple doesn't need, Apple generates so much of a cash. But if you look at how much of a debt Apple has on its balance sheet, you would say, why the heck? You generate so much of a cash. Why the heck you need... let me just bring Apple. Why the heck you need so much of a debt on your balance sheet? If you look at Apple, right, total current liabilities, long-term liabilities is $124 billion because they can raise money at very cheap price, maybe 50 basis points. When you can raise money at such a cheap price, why not? Right? So these are what the corporate bonds are. I'm not going to get into the details of every corporate bond, right? But when you're buying corporate bonds, be aware of these callable and puttable bonds. Some of them bonds are callable, means, let's say you bought a corporate bond which is paying 6%. Again, the rate that the corporates pay is dependent on how well the market perceive the risk of that company not honoring its commitment, right? What the credit rating of that bond is. So these bonds will go through the credit rating agencies like S&P, Fitch, and Moody's. They get rated, and based on their rating, their interest rates will be determined. Let me first go through the rating. So as an investor, the top rated, these are the investment grade bonds, AAA, AA, BBB. As you go lower down the rating, you will start to get higher yield, higher interest rates. Non-investment grade, BB, B, CCC, C, D plus, and then you level like D plus, minus, etc. The risk that you need to be aware of is, even though the mentioned rate, coupon rate on these high yield bonds will be higher, you can actually get 6%, 7%, 8%, 10% bonds, corporate bonds, so-called high yield or junk bonds. But then you need to be very well aware of how to pick the right company, because you have a huge risk of company not being able to, deliver on this. Company could go bankrupt. Then you'll be in the bankruptcy court. You don't know how much of the assets does the company have. So if you're trying to deal with these junk bonds, go with very astute junk bond managers. If you want to stay with the safest one, maybe you can pick up some ETFs. Right? You'll get a little lesser percent, but the default risk is less. So focus on the rating. Other thing is focus on the callable feature. Some bonds are callable, means the company can, let's say the bond duration is 5 years, and you're looking at for 5 years, it's like 5% per year. Great, I'm going to invest in it. But their company will inject a callable feature in it, saying it is callable after 3 years. Then what? After 3 years, the company will be able to call back their bonds. You didn't get 5% for all the 5 years. Right? So in that case, if it's a callable feature, focus on something called YTW, yield to worse. Not yield to maturity, because they could call before maturity of 5 years. Focus on yield to worse. That will tell you, in case the bonds get called, what you could have made in that worst case scenario. That's what I want to point it out. If you are interested in investing in corporate bonds, I don't do distress investing. I don't have a capability to go and look at the companies and see what assets, if it goes bankruptcy, are the assets valued more than the overall debt. If I were to do the distress investing, I would go with the famed investors like Howard Marks, etc. Maybe invest through them. But I will not do, or I'll stick to the triple rated corporate bonds. Another one would be your convertible bonds. I think, where's the convertible bonds? In which the companies, basically, these are the bonds which will then get converted into the stock at a particular price point within the particular time period. So recently, a lot of these treasury asset companies, like say MicroStrategy, has been raising a lot of cash by offering convertible bonds. Many Wall Street firms have desks that are dedicated to convertible bond trading. And they are picking up these MicroStrategies convertible bond offering. Like companies like insurance companies, a lot of insurance companies will pick up these bonds because it will give you a predictable stream of income. Plus, because these can be converted into stock at a later point of a time, you got an inherent call option embedded in it. Right? So if you know how the pricing of this happens, go and knock yourself out. I generally haven't even dealt in any of the corporate bonds. Right? I haven't bought either the Apple corporate bonds or any other high yield junk bonds. But I want to bring it up that this is a way to get, looking at 6-7%, corporate bonds is a way to get it. Okay. Third one is municipal bonds. Right? This is where your local taxes that you pay go in. Right? This is where the government will say, we are building bridges, we need to raise money. They raise it through you. Right? You can buy these bonds. So these are what the counties, cities, local government use to build bridges, to build sewerage system, to dig a new pipeline to get water to your place, or fix the roads, etc. And then the roads, basically they'll raise bonds. And again, it is as good as the financial health of your county or your city or your government. There are some general obligation bonds which is backed by the power of the government or the county, and then there are revenue bonds which are secured by a specific project. Let's say highway toll booth. Right? If you're investing in revenue bond, you need to at least have some idea about, will they be able to generate enough revenue from our tolls or not? Right? Lease, etc. Again, I've never owned a municipal bond, but one big attractive feature of municipal bond for those who are in a high tax bracket is the taxation treatment, right? It is the interest income is exempt from federal income tax. So those who are in a high tax bracket, or those who cannot find any other avenues of saving taxes, for them, it is a very, very attractive way that you can get a fixed income Also, you're contributing to your society, and you can get that income interest free. So whenever you're investing in any of these fixed income, always look at post-tax return. So while the coupon rate, which is the stated rate on the bond, may be only 3% or maybe 4%, right? But it is better than having a 5% which get taxed, because post-tax, 4% is much bigger. If you're in a 5% invested in 5% bond, corporate bond, which get taxed at your regular tax rate, you're in a higher tax bracket, your net return will be less than 4%. So look at that. Obviously, it is also, have the credit risk. What if your government defaults? We have seen some other counties going bankrupt. In that case, you'll have all those issues. But you can buy all these things on your brokerage platform. Okay, municipal bonds. Next is preferred shares. Again, I've never bought a preferred shares, but it is a way. So preferred shares are the shares that are issued by companies, which will give you fixed dividend payments more than what you will give it to the normal common shares. The stocks that you and buy on the stock market, those are called common stock. Did you ever think why they are called common stock? Is there any other kind of a stock? Yes, there are other stocks which are called preferred stocks, which is what Warren Buffett would like to buy. So when 2008, when there was a whole crisis, Bank of America was going under, Warren Buffett gave them what, $5 billion to Bank of America. Goldman Sachs bought a preferred shares that was giving him 8% or 9% interest or dividend income, right? So you get a higher fixed dividend payments, plus you are ahead in the line in case the company goes to bankruptcy. It's a senior debt, which means you get preference over the other lenders. So if you're interested in this, preferred shares could be a way. Right? But again, if you're invested in the individual companies, you need to know the health of that company. Right? Key benefits are higher and more secure dividends. You get a higher yield. You are a priority in payouts. Even if the company has not generated enough cash to pay dividends to common stockholders, they will still be paying it to preferred shareholders. You are first in the line on the claims or if the company goes bankrupt, you have a priority in the liquidation. You are first in the line. You're ahead in the queue to get the value from when the company is getting liquidated. Some of them are cumulative dividends. The common stock dividend are not cumulative. Disney decided in, I think, 2022 to not pay dividend. And I think Intel cut their dividend because they're not making enough cash. So we're not going to pay dividend. So these preferreds have a cumulative dividend. If they're not paid you dividend this year, if they have suspended it, it's going to accumulate over the years. You will still get paid your dividend if you're a preferred shareholder. So if you're a fixed income investor, this may be a way to look at it, right? And of course, the lower price volatility. The trade-off that you're going to do is your capital appreciation. The preferred shares don't rise as much as your common shares would if the company does great, right? It's not the same ticker that you're going to buy. It will be a different ticker. And but you're giving up that capital appreciation or the capital loss. That's a trade-off you're doing in exchange for a fixed income, higher in priority, cumulative dividend, etc. So there is no free lunch. There is always a trade-off. You just need to understand what a trade-off in the market is. Or if you don't want to, identify individual or understand individual business, etc., there are ETFs available which do in a preferred. They invest in preferred shares. So PFF is the biggest one. It's giving you currently 6%. Right? Not bad. PSK, FPE, you can find out whatever your favorite ticker is. This is also a way to invest. Warren Buffett wants generally invest in a lot of these directly into the preferred shares. All right, next one, mortgage-backed securities. Right. Okay, you can invest in on the mortgage-backed securities. Basically, these are when you pay your mortgage, it doesn't stay with the bank that you got your mortgage from, right? They will immediately securitize it and sell it to the Wall Street firms, which basically these are the securities which are backed by the mortgages that homeowners pay. So now there are ETF available on these mortgage-backed securities. The thing is, people generally pay their mortgage. This is the last loan that they will default on. So you have more surety of your monthly payments coming in, right? It's a good asset diversification. You are basically diversifying into real estate, right? Different asset class. And you could get a higher yield. But you could also end up in a situation like happened in 2008, wherein the mortgage market itself blew up, right? So that risk is there. But it is a way to invest. And then another one is agency bond. These are like government-sponsored entities, GSEs like Freddie Mae, GM. There is another one, GME or something, which also, these are quasi-government issued bonds, right? These are not your state or local government, not a federal government, but these are government kind type agencies. They also issue bonds. These will be backed by government, so it's a little risk-free. It's not as much risk as a corporate bonds, but if you want to invest in agency bonds, you could. So these are all a lot of stuff around bonds, federal bonds, agency bonds, corporate bonds, mortgage bonds, and your state and local authorities, municipal bonds. Next, let's look at a fixed income through dividend, which most of us are very familiar with. Dividend income. You can invest in dividend stocks. But I pulled up a list of dividend stocks. This is the list of average buy or strong buy from at least 10 analysts, and they have a dividend yield of at least 3%, payout ratio under 60%, means they can sustain the dividend. Shows up some companies. Right? Let's say you buy Target. If you're buying Target, because today you can get, if you buy Target, you can get 4.92% of dividend, right? Unless the company cuts its dividend. But don't look at the Target stock price. Remember, you bought it for a dividend income. If a Target continues to pay the dividend that is paid, you'll continue to receive your dividend income every quarterly. The stock price, the overall return, which includes your capital appreciation plus the dividend income, is a different story. But here we're talking about getting the dividend income. So I generally don't invest. I'm not a big dividend income investor. I would rather buy a good growing business than a business that is declining but paying out a lot of money in dividend. Because if you're not able to grow your business, better return the capital to the shareholder, either in form of dividend or share buybacks. I would rather invest in a companies which are growing their businesses. I don't have right now a need for consistent income from dividend side. I use options to generate it. But it is a way which there are a lot of forums dedicated to just dividend investing. If I were to invest, which I do invest, this is my top few holdings. And again, within the dividend, there are different categories. Like dividend kings are the companies that have raised their dividend for 50 years or 50 or more years. Every year they will raise the dividend. Dividend aristocrats, they raise their dividend for every year for at least 25 years, right? So some of these companies mean they've been around for more than 50 years, first of all. Means they have a business that you just can't easily disrupt it. And they have been probably doing some good stuff that they can sustain their dividend for 50 years, means they're able to have a positive cash flow. They have a cash left and been able to raise it every year. So indirectly, having a good dividend tells you something about the business, that stable business may not be growing like crazy, but management is able to generate cash and return it back to you. My preferred way is, if I want to diversify into more stabler businesses, I go through the dividend ETF, SCHD. As you guys saw last week, it's my top 5 positions. Not that I'm gunning for this dividend income, but just that by owning SCHD, I will own some of the very stable cash flow generating, income producing companies. Some of these great stock return companies don't produce any income. They're all leading to losses, right? Which is okay, as long as the market is good, they'll continue to reward you. In case when the market gets into crisis, where everyone goes out, they will go out to the companies which are sound businesses, generating cash, and wait until the winter passes, and then get back into the more growthy names, more hyped names, etc. If we go back and look at 2022, while S&P was down 18%, QQQ was down 40%, all the growthy tech companies, ACHD performed much better than these. So it'll give you a little more balance in your portfolio. That's why I own this. And second reason, it is also optionable. So that's why I own it. But these are some of these dividend ETFs, right? And you can own this at a pretty cheap expense ratio, right? 6 basis points, almost nothing. So if you don't want to have a risk of buying individual company, with today's paying great dividend, but the business, if it is declining, eventually the company will vanish. Maybe pick an ETF, because they will do all the work of finding a next better business for you. Okay. VIG, ACSD, VYM, DGRW, Noble, pick your poison. That's the dividend income. The latest crop, which I've been seeing over the last 3 years, it's been option income-based ETFs. They claim that it is a dividend, sort of. In IRA terms, it's actually not a dividend. And I've seen explosive growth in this. And you would ask me why? Why in the last 3 years? What happened in the last 3 years? Since 2022, Fed started to increase the interest rates. What happened if you increase the interest rate? What happens to the calls and puts? One of the option Greek is rho. We never bothered about rho, which basically determines your interest rate sensitivity to your option pricing. We go back to the Black-Scholes model. Never bothered about it because interest rates never change, right? Fed will do 25 basis points, whatever. But now, Fed increased interest rates at the fastest pace that we saw in the last 40 years in 2022. Suddenly, you see that a lot of the call options have become more expensive, were valued more than they were in the past. And no surprise, if you're watching the markets, which we have been doing, I saw a lot of these instruments in the market, not just income-based. You see a lot of annuity issuers came up with the defined risk annuity plans. They all make use of options to give you portfolio protection, etc. Or the trade that we discussed on the collar, there are instruments or the companies that will basically give you collar protection and charge you 1.5%. I'm like, leave it. I'll do it myself, right? Why pay them 1.5%? But there has been a explosive growth of these because you are getting good premium by selling call against it. And no wonder you see a lot of these interest in JEPI, QYLD, GPQ, covered call ETFs coming in, because now you can get paid a lot more in covered call income. than what you were able to get in, let's say, 2017, 2020, right? And also the VIX has been a little higher, so that also adds to it. But if you want, these are some of them which are available. But as always, I don't know how they're going to perform once the Fed starts to reduce their interest rates, right? So I'm not in any one of these because anyway, I sell call against my stock positions anyway and generate whatever the regular stream of income. Why would I pay them 35 basis points? Why would I pay them 60 basis points? Leave it. But it is away. Not surprised that on X, many new retail investors have discovered covered call selling as the best money hack that one can ever find, right? And now suddenly they become guru on how to sell covered calls. I'll wait. Once the interest rate goes down, then I'll see what they have to say. In any case, right? Other thing that you have to figure out is these. Go and read into the prospectus or in their annual report on how this dividend is classified, right? Especially on the yield max. You look at this 49, 50% dividend yield, people go crazy behind it, right? But you're not going to get this dividend yield, your overall return. As an investor, you need to focus on your overall return. I'll pick an example of, let's say, whichever you want to pick, TSLY or Coney, etc. They all charge close to 100 basis points. This is something equivalent to saying the return that they give you, majority of the return is something called a return of your capital and not really the dividend income return. Some portion is coming from selling an options against what you've given them. Majority of the portion is coming because they're giving your money back to you. Example, let's say you gave me $100, $120, okay, to invest for next 1 year. Now, every month, I'll pay you $6. So that means over the 12 months, right? Hold on. You gave me, let's say, $6. So that means around what, 20%? Right? I pay you back $6 every month. That's what, 5%, right? Yeah, 5%. It means the yield is 60% at the end of a year. Not really. I got 120 from you. I'm giving you $6 every month. It's your money. I just gave it back to you. And I'm charging you, what, 1% for doing it? Understand how much is coming as a return of capital versus the actual dividend. Number two, all these dividends are non-qualified dividends. Yield max dividends is non-qualified dividends. Means it get taxed as your regular income. It doesn't get taxed as your dividend income, right? So you need to understand that as well. Before, I know a lot of people, especially retail investors, are crazy when they look at these numbers, 50%. They say, come on, I'm going to get 50% anyway, right? So the risk is less. Dude, it's your money. They're just giving it back to you and charging you a percent. So understand what you're getting into. And I'm so tired of sometimes I feel pity about these ones. This is Coinbase, Coney. Last 1 year. Year to date, it's down 50%, right? This is Coinbase. Year to date, it is up 17%, right? Maybe you should have just invested in Coinbase. MSTY. Year to date, down 40%, right? MSTR. Year to date, up 12%. Yeah, you can say they got a dividend income, add capital loss and the income. Did you really make money? maybe little. Its math is not that easy when you're doing this yield max stuff. And these have exploded in popularity because a lot of retail investors are just putting money in it. But it is a way, right? I'll skip that. It's not qualified. Other stuff. And last one is a commercial paper. This is what also known as, we looked at the corporate bonds, but corporate bonds are generally secured. Commercial paper could be an unsecured ones, right? You can invest in REITs, which is you can buy. Basically, this is backed by the real estate properties, etc. You can do peer-to-peer lending. I tried long back with an account on Lending Club, but then realized when I started it for the first year, it was like 7 or 8%. Over like 5 years, it trickled down to 2 or 3%. I withdrew all my money. Didn't work out for me, but it is a way that you lend money to others on a peer-to-peer lending platform. You basically get a fixed return on your whatever the interest rate is, and you can pick up which kind of credit worthiness borrower do you want to lend it to. If you're with a lower credit score, you'll get a higher percent point, but then you have a more default risk, etc. And the latest one is coming to CLOs. I see CLOs are, you're going to get an ETF based on CLOs, which is collateralized debt obligations. This is what killed a lot of companies during 2008 mortgage crisis. Stay away from it if you can, if you don't understand the details of it. But I'm seeing a lot of these instruments coming back in the market. I think Apollo and someone else were trying to create an ETF based on CLOs. And here we're talking about Fed to reduce the interest rates. Okay. So these are the various ways of fixed income investing. Probably there are more, but I did not have time to look for more. Some of the strategies that I have followed around laddered side, but there is a way in which doesn't matter what paper or instrument you pick, you can do a laddered investing, which is I have on my CDs. So I have my emergency fund in CDs. I started with 1 year, 2 year, 3, 4, 5 years, and once the first one matured, renewed for 5 years. I've been doing it for years now. I have all 5-year CDs. This is called you laddering, right? So that every year, basically, you will ladder either your CDs or I did the same thing for treasuries as well. That you ladder your maturities so that every month or every specific time period, you have something which is maturing. And then once that mature, I'm going to renew it with the, let's say, next 5 years, so you get a higher percentage, right? Something called bullet bond portfolio investing, right? This will be more applicable to someone who have a end date in mind. You know what? That could be, maybe my kid is going to a college in 2030. Then I will probably pick up, I'll buy US treasuries this month, 6 months later, year later, but everything is maturing in 2030 so that I need that fund out all together in 2030. This is called bullet bond investing, right? Pick up your maturity if you want for a particular, on a particular date. Third is barbell, which is short term versus very long term, which is where like ICSH for my short term, I have parked the cash in ICHH. Long-term bonds is where I have a TLT. Right? There are ways. There is no right or a wrong way. It all depends on your portfolio, how you want to construct your portfolio, what your needs are. Right? Where can you buy these? Don't have to go anywhere else. You can buy all these things on your brokerage platform. This is a screenshot from Fidelity. I also took a screenshot from Charles Schwab, but probably didn't end up in this document. But you can go to your brokerage platform, look for fixed income, or maybe there will be a tab called fixed income. Under that, you will see bonds, you will see government bonds, you can see CDs, etc. Go and buy it if you want to. I'm not telling you to, but if you're interested in fixed income, these are the various avenues available to you. All right. All right, we hit our mark, 12:30. Happy to conclude here our stated agenda for today's meeting. Now I'm all up for we can get into breakout rooms and talk about anything else.